everybody. Welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Ben Willis, Director of Floor Operations for Sunrise Securities here on the New York Stock Exchange. Ben, thanks very much for coming on the program.
My pleasure. Thanks for having me.
Appreciate it. You've been down here a long time, 25 years. Give us your impressions recently of, first of all, sort of the climate now. With everything going on, with the crises we see around the world, in Europe, with the problems here in the United States, economic weakness, the jobs crisis, the sort of the political dysfunction that we see. How do you guys down on the floor feel about this? I mean, are you just like, just let it roll off your back, chill? Or, I mean, are you really concerned?
Well, traders love the volatility. But every line you just went through, if you just took a soundbite of every single issue you brought up, that has moved the market every time that has happened. We have been a headline-driven market for months now, and today's a great example. The market looked like it was going to fail earlier this morning until the ECB came out and said they're going to create more liquidity with U.S. dollars and other central banks. Every time there's a story about one of the pigs out there, the market moves. Whether it's Greece, now it's Ireland, then what Merkel is going to do, and what one of the ministers said that's outside Merkel's zone, or whether the freeze in Washington, the inability of this administration to get done what they see necessary to get done. Every single time a headline hits, the market is moving. So the market, the equity market in particular, has moved away from fundamental analysis and has become a function of the next soundbite, which is moving the market.
That can't be a good thing, right?
It's not a good thing for the individual investor. It's a good thing for traders. Because we make money when markets move, and the bigger the swings, the bigger the volatility, the bigger the delta, the bigger the profit margin is on any given trade. You don't have to hold them anywhere near as long to get the same movement in a stock.
But how does that play? Now, historically, though, the stock exchange has been here to raise capital, to help companies, maybe new companies, maybe companies already in existence, to expand. But this volatility and this sort of headline-driven, now, it's not a new phenomenon. I mean, you could go back in history and we've had panics and there's been depressions and recessions, but now everything is magnified, right? So do you think it's become itself a negative factor in everything that's going on?
I believe equities are a second-class citizen in the asset class.
Really? What's the first-class citizen?
Well, first-class citizen right now is the U.S. Treasuries.
Okay.
Followed by gold. And what I tell my family members who are sometimes become panicked over what's going on is a very simple idea. There was a guy by the name of Peter Lynch who ran a little fund called Magellan and wrote a book.
Yeah, in the 80s. He was
and his story, the way he made his money and made Magellan what it was, he said, you buy equities, you buy companies that you know and understand what they do, but save some money to buy it when it gets cheaper.
Right, which I think is what Warren Buffett does as well.
This is the opportunity as an investor on months like we're in right now. This is the time where you should be adding to your equity portfolio, even if it's a gold stock. For whatever reason, gold stocks have underperformed the gold itself. But
gold
this is the time.
Not cheap, would you
no,
say?
Gold is not cheap. And again, I don't think it's, in my own opinion, if you ask me opinion on I think equities as an asset class are way undervalued. And by any historical means you want to look at, and where they've come from and where I believe they will go back to. I think gold is as an asset is one I scratch my head over. I truthfully don't understand it, but I think it's been driven by the fear that we're talking about in these headlines. It is a place where investors that keep money other than under their mattress put money as they view it as a safe haven, whether it's
and some people say it's a currency. Do you buy that? Do you buy that it's I mean, that's a lot of the rationale that you hear right now for owning gold. Hey, it's a currency, it's the alternative currency. All other currencies are getting debased. You got to own gold. But
it is.
Do you buy that?
No. But it is a currency. I can't stop that from happening. And you can have the whole argument whether a greenback is what's a greenback worth. It's based on the value of the word of the American government. So we can go back and forth on what it is. My only question is, if you believe gold has some intrinsic value as a currency, how much are you going to have to load in a backpack to carry across the border if something really dramatic happens? If you're looking in the marketplace, it's not as sexy as gold, but a far better return for an investor has been silver, which has intrinsic value, it has industrial value,
Right.
and it still can be used as a currency and has been for centuries. So, but it doesn't have that sex appeal that gold has managed to maintain as a brand, if you will, that's been absolutely phenomenal. The other function that I will go back to in this whole marketplace, as we discussed, I've been in equity and options exposure my whole career, is the ETF has changed a great deal of the investing public, so that those people that are still investing may be investing in equities, but they're doing it through a different vehicle that are the exchange traded funds. And that has had a huge impact on the marketplace, but has also added to the volatility, again, with some of the derivations when you have double leverage and triple leverage. That adds to the volatility, especially when you have the
But
VIX where
does
it
it
is.
add or reduce to the actual understanding of what's going on? I mean, as you mentioned, it's easy now to invest in a lot of these things, gold, maybe corn, some other agricultural product, just by buying an ETF.
Right.
But look, back in the day, I was a commodity trader. You kind of had to know a little bit about the fundamentals of what was going on if you were trading commodity futures. Now you get a lot of people, hey, I just want to own this because I believe it's an asset class and I'll just own it, because of that. And if the price goes up, hey, I got to own even more of it because I want it to be X percent of my portfolio and I want it to maintain X percent. That kind of drives it, doesn't it?
That is exactly what's been driving, particularly the commodity side, where you have people that don't have an understanding, as I said earlier, the fundamental understanding of Peter Lynch, you buy what you know. I don't know why I'm in this commodity complex that my advisor told me to be in, but it's worked out pretty well. And I believe the function of why you see gold moving, why you see oil moving, why you see corn moving, as you know, going back in the day, you would look at different crop reports and the yields and acreage yields. What's more important, in my opinion, that's moving commodity markets is the flow of money. The flow of dollars
Right.
is what's driving, not the fundamentals. If fundamentals were driving oil right now, West Texas Intermediate would not be trading where it's trading right now because Cushing doesn't have any more room to hold it. It's being driven by fear. It's been driven by money going in. And, it's funny, a couple of years ago, the Commodities Commission came out and told us speculators don't drive the price.
But they haven't done a lot to curtail that.
Right.
I mean,
well, now they realize that they were looking at the wrong information. That in fact there is some validity. That if you look at pure money flows,
Right.
there are, and it doesn't take many that are in the marketplaces depending on the commodity level. But you have to extrapolate out and know where the money's coming from. If people are buying the GLD ETF, that is moving. Now, GLD is now one of the largest, if not the largest, on any given day, the
Bigger
largest
than
gold
the
holder.
SPY, which
Exactly.
is the S&P index.
But they're the largest holder of gold in the world.
Right.
Not the Chinese, not any individual government, not the United States government. That is money flow into a commodity.
But what happens when those people want to monetize that gold? They have to sell it. And traditionally, the buyer has been the jewelry industry, which I believe their consumption of gold is actually going down.
Right. At $1,900 an ounce, a gold watch is even more expensive. And in an economy like this, you're not seeing that even in the places that had been traditionally driving it, where it's more of the gold was more. You'd have to watch India in particular for their consumption of gold. So the buyer of last resort is going to have to be the ETF who created it. So we haven't seen that panic yet, but we do start to see what can happen because there are very few ETFs, unlike gold, we're going back to the equity-based ones, that can be cleanly hedged on a one-to-one basis. That goes back to the trading, which the individual investor doesn't have really any real knowledge of why that is. But that's why it's a very dangerous place to have the double and triple leveraged
Right.
ETFs that we have, not just in commodities, but we have it in
So
equities.
I'm going to ask you to go out on a limb a little bit here.
Better be a big limb.
5-year prediction, gold price, significantly higher, where it is today, or lower?
Significantly lower.
Significantly lower. Yeah. All right. Ben Willis, thank you very much. That's it for now, folks. I hope you enjoyed it. See you next time. This is Mike Norman. Take care. Bye-bye.